Good afternoon. This is the second part of the presentation for chapter number 4. It deals with learning objective number 4 and the rest. First, we are going to talk about learning objective number 4. Uh, it, it will explain or it deals with the accounting cycle. Now, what is the accounting cycle? Of course, it is the complete steps involved in completing the accounting process. The accounting process that begins with analyzing and journalizing transactions and ends with preparing the accounting records for the next period's transactions is called the accounting cycle, and there are 10 steps in the accounting cycle. The first step is the transactions are analyzed and recorded in the journal. Please understand, we don't record everything. We'll be recording only those transactions and events having financial implications which can be measured in terms of money. So that would be number one. And once we have analyzed and recorded those transactions in the journal, we'll be posting them into the ledger. So ledgers are individual accounts. They track the changes in those individual accounts, increases or decreases, and ultimately the balance. And then once we have done the posting to the ledger, we'll be preparing the unadjusted trial balance. We have already learned that in chapter number 2. Yeah. So chapter number 2 dealt with journal, ledger, and the unadjusted trial balance. And then in chapter number 3, we talked about adjustment data. So first we'll be assembling the adjustment data and analyzing them. And then once we have assembled the data and analyzed them, we'll be preparing a worksheet. That's an optional worksheet, and it is kind of a spreadsheet where we'll be recording all the transactions. And then what we'll be doing is once we have analyzed the adjusting uh, requirements, what we do is we journalize them as adjusting entries and then we post them to the ledger. Please remember that while posting to the ledger, we'll have to mark them as adjusting entries so that we know these are adjusting as a result of adjustments made to those accounts. And once we have done the adjusting entries, we'll be preparing an adjusted trial balance. That also we learned in chapter number 3. And then after we have prepared the adjusted trial balance, either by using the adjusted trial balance or using the worksheet that we did, we'll be preparing the financial statements. The financial statements, of course, we learned about the financial statements in the first chapter. We'll be revisiting them in this chapter as well. The financial statements we learned were the income statement, statement of owner's equity, and the balance sheet. Only difference from the balance sheet that we learned to prepare in chapter number 1 is in this chapter we'll be doing a classified balance sheet. After we have prepared the financial statements, we'll be doing the closing entries. Now, closing entries are journalized and then again posted into the ledgers. Now, we don't open the ledgers separately. We'll be using the same ledgers that we have already opened. Only thing that we are doing in the item, under the item, we'll be writing closing entries so that we differentiate the general postings and then the adjusting entries and closing entries. For general postings, we don't write anything, it's understood as general. But when you do the adjusting entries and the closing entries, we'll be writing them as such so that we know these are adjusting entries or closing entries. And then finally, we'll be preparing a post-closing trial balance. That's the last step in the accounting cycle. So this is a graphical representation of the accounting cycle. What we do, number one, we journalize the transactions in the format that is given to you here. And then there are separate ledger accounts, and what we do is we post the journal entries into these ledger accounts. And then once we have done with the ledger accounts, we go and prepare the unadjusted trial balance. So once we have unadjusted trial balance prepared, we calculate or we assemble the adjustment data, because we'll have to see whether there are any adjustments to be made or not. And then once we have assembled the adjustment data, what we can do is we can use an optional worksheet to assemble those, or we may not. And then once we have them, what we do is we journalize those adjusting entries again, coming back to the journal, and then post those adjusting entries into the ledger. So that will be the number 6 step. And in the 7th step, we'll be preparing adjusted trial balance. So we'll come back and prepare the adjusted trial balance. That can be done in the worksheet as well. Once we have done the adjusted trial balance, we will go back and do the closing entries. And, um, and then we'll post the closing entries. And then finally, then what we do is we take either from the adjusted trial balance or from the worksheet, we'll be preparing the financial statements as step number 8. So then finally in step number 10, you'll be preparing the post-closing trial balance, that it will be the end of the accounting cycle. So that's how we will be following. And of course, as I said to you, we could do a spreadsheet that is known as the worksheet in order to prepare the financial statements. Now, financial statements could be prepared either from adjusted trial balance or from the worksheet. So that's the option. So these are the steps that we talked about, the summary of the accounting cycle. Now, next learning objective deals with an illustration of the accounting cycle for one period. I'll not be doing that problem. What I'll be doing is whatever problem is done in the book, I'll be just showing those as part of the illustration for one period. Now, the first step, of course, what we are going to do is we are going to do the journal entry. So, as you will be able to see in the book, Exhibit 9, the journal entries for Kelly Consulting were done for the month of April. So, that is what we would be doing first. And then we'll be organizing those journal entries into separate pages. Once we have done the journals, what we do is we post them into the ledger. So you'll be able to see the ledgers in Exhibit 17 of your book, Chapter 4. Now, here, as you can see, what we are doing is we are posting all the ledgers that we have done. Whenever we are posting the general ledgers that we have done so far, we don't write anything in the item column. But we'll be writing adjusting or closing when we do the adjusting, post the adjusting entries into the ledger. So these are all your the ledgers that we prepare for Kelly. And then once we have prepared the adjusting posted the transactions into the ledgers, we'll be preparing an unadjusted trial balance. So this is the format of an unadjusted trial balance. Now, these are before the balance. You'll have to, whenever you take those balances, you'll have to take before the adjusting entries. So that would be what you will be doing, because we haven't done the adjusting entries. The adjusting entries and the closing entries, we come back and post them at a later stage. So that is your unadjusted trial balance. And at that stage, what we can do is we can also do end of the period spreadsheet, that is known as a worksheet. Now, worksheet is only a scratch pad for the accountants. It's not an official document. We want to just have a look at what are the accounts and what are the adjustments to be done, and we calculate the adjusting trial balance by comparing the figures with the unadjusted trial balance and the adjustments. And sometimes we extend the adjusted trial balance into income statement and the balance sheet figures in the same worksheet. So that helps us to have an overview of everything that's going on in the organization. Once we have done that, what we do is we do the adjusting entries. Now, as you know, adjusting entries um, are completed, and then once we do the adjusting entries, you got to remember to go back to the ledgers and um, post them into um, the ledger account. So as you must have noticed in the ledger accounts, there are entries here like adjusting and adjusting. All these have come up from the adjusting entries. So that is how we do the adjusting entries. Then after the adjusting entries are done, we'll be preparing adjusted trial balance. So to prepare the adjusted trial balance, there are two ways of doing it. Either you take this worksheet, whatever adjusted trial balance we have prepared, the columns have been included, just copy them and put them in a proper format. Or what we can do is we can directly go into the ledgers and from serially what we do is we take the balances. So this is the balance for cash account, and this is the balance after adjustment in prepaid insurance, that is the balance in office equipment, this is the balance in the adjusted accumulated depreciation account. So after adjusting entry, whatever balance you would have calculated, you will be able to take, you should be able to take that to the adjusted trial balance. So now here, supposing there are some closing entries, so what we need to do is we need to take the balance that is calculated before the closing entry. So this is 30,000. You have to be careful about that. So that is how you will be doing your adjusted trial balance. Once you have done with the adjusted trial balance, we can go ahead and start preparing our financial statements. The financial statements can be populated either from the adjusted trial balance that we have prepared, like this trial balance that we have prepared, or what we can do is we can use this worksheet to populate the financial statement. So either way you do it, you can complete the income statement. Of course, while completing the income statement, you'll always start with the revenues and then add up the revenue. If there is only one revenue, you don't have to calculate total revenue column. Otherwise, you may have to, if you have two separate revenues, you may have to add up and write the total revenues, because we want to know the total revenue. And then list all the expenses in the descending order with the miscellaneous expense as the last item. And then total the expenses, revenue minus expense would be the net income. And statement of owner's equity, again you should start with 0 if it is a new business. If it is an old business, there will be some amount in that capital account, so we'll be bringing that. Then any investments made during the period, net income will be added, and you calculate a subtotal and subtract the withdrawals or the drawings made by the owner, and finally calculate the increase or decrease in owner's equity, which should be added with the opening balance to calculate the new balance of capital at the end of the period. Then we go on and prepare the balance sheet. Of course, in the balance sheet, please remember that we do a classified balance sheet. So we organize the classified balance sheet as current assets, property, plant, and equipment, and sometimes you may have some investments in between. Um, for now, we will not be dealing with the investments. And then on the liability side, we'll have a current liabilities and the long-term liabilities, and the owner's equity section will be the last item on the balance sheet. So then once you have done the financial statements, we do the closing entries. So now please remember, once we have done the closing journal entries, we have to go back again to the ledger accounts and then post these closing entries so that the ledgers are zeroed out, the temporary accounts especially. And then once we have done the closing entries, we'll be preparing a post-closing entry, post-closing trial balance. This will include only the permanent accounts that will be carried forward to the future period. Now, the next thing that we will learn is types of years that the businesses use. We all know that every business will be adopting accounting period, and usually the annual accounting period that's adopted by a business is known as the fiscal year. So that will be its fiscal year. So some companies start with January and end in December, some start with 1st of April and end on 31st of March. Some companies start on 1st of July and end in 30th of June. So that is, of course, it depends upon. Now, sometimes businesses adopt a fiscal year that ends when the business activities have reached the lowest point in its annual operations, such as the fiscal year. Such fiscal year is called the natural business year. Supposing like we are very near to Virginia Beach and the Naxade Beach area. Now, these they will be having a kind of a nose dive to their business around October, November. So if they end their business accounting period by November or by October, then we'll be considering that as their natural business year. So that is how we understand by that natural business year. Now, these are the recent fiscal year ends of some well-known companies. Um, Amazon is December 31st, Apple is September 24th, AT&T is December 31st, Bank of America is December 31st, Cardinal Health is June 30, Cisco is July 30, Cisco Wholesale is August 28, and Dell is January 28, eBay December 31st, General Electric, Google is also December 31st, Microsoft is June 30, Nike is May 31st, Walgreens is August 31st, and January 31st, Walmart and Walt Disney Company is October 1st. So what you have to understand is whatever date that you end, you'll have to have a complete 1 year period. So if you're ending on December 31st, you'll be starting with the January 1st. If you're ending like Apple is ending on September 24th, that means they will start on September 25. So that is how. So now, as I said to you, some companies use a fiscal year which is quite normal, like a calendar year or a financial year, but some companies use the natural business year. So that is why you see quite a bit of difference in the years. Now, the financial history of business, of course, it will comprise of the income statement and the balance sheet, and of course, it will also have subsequent years of income statement and the balance sheet and the cash flows and the statement of owner's equity. So, usually, all companies provide information for 2 years. Some companies even do provide for 5 years. Now, the last learning objective in this is uh, number 7, describe and illustrate the use of working capital and the current ratio in evaluating a company's financial condition. Now, these ratios are very, very important and they are used very frequently by financial analysts and other people to gauge whether a company is doing well in terms of paying off its liabilities or not, or what is the amount of working capital it has to operate on a day-to-day basis. Now, if a company has to always borrow money from someone to do the working capital, then probably that company is not doing very well. So that's why we would like to know how a particular company is doing well. And sometimes these ratios are known as liquidity and solvency ratios. How solvent you are, that means whether you are able to pay off your liabilities with your own money or not, or how liquid you are. That means do you have assets that can be sold off immediately in order to pay off your liabilities or not. So the working capital and the current ratio, They will be showing liquidity ratio. The ability to convert assets into cash is called liquidity. So how liquid you are, and the ability of a business to pay its debts is called solvency. So those are the two areas which the current working capital and the current ratio will provide a snapshot of a company. Working capital is the excess of current assets of a business over its current liabilities. Now, looking at this working capital, it would make sense to you to have a balance sheet which has a current assets total and a current liabilities total. Otherwise, if you just list them without bifurcating or having a sub heading as current asset or current liabilities, it would be pretty difficult to really to calculate those amounts. So that is why for easier analysis, that is what we do. We prepare a classified balance sheet. Working capital and current ratio for net solutions. Net solutions working capital at the end of 2013 is 6,355 as computed below. That is 7,745 is the current asset and minus the current liability is 1,390. Now this amount of working capital implies that net solutions will be able to pay its liabilities easily. The current ratio is another means of expressing the relationship between current assets and current liabilities, but it is in a ratio form, and therefore we'll be calculating by dividing the current assets with the current liabilities. So for net solutions, it is 5.6. Now, rule of a thumb, usually anything between 1 and 2, a ratio of 1 and 2 is considered as pretty good. Now if you have more than that, then possibly you have more current assets than the current liabilities that you require. So sometimes you are not utilizing your current assets well, so that could be the possibility of a high ratio. This is a pretty high ratio where you may have unused current assets lying idle, and you may have unnecessary blocked some of your working capital in some of the current assets. You may want to invest and grow that money. So that is about the working capital. Now the last thing I need to do in this presentation is with the worksheet. I just want to show the worksheet. Now in the worksheet, this is how we do. We always start with the unadjusted trial balance. Before the unadjusted trial balance, the worksheet is not done. So when do you do the unadjusted trial balance? We already know. After we have journalized and posted those journals into the ledger, we calculate a balance, and those would be the unadjusted trial balance. So once you have listed all the balances with the unadjusted balances in the ledger, what we do is we do adjustments. Now sometimes as supplies needs adjustment because we have used some of the supplies. So cost of supplies at hand is at December is 760. So therefore what I need to do is I need to find out how much supplies has been used. So the supplies used is 1240. That's 2000 minus 760, and this is how I'm going to populate my adjustments. For B, the insurance expense for December is 200. So prepaid insurance out of the 2400, 200 has been expensed. So we'll have to mm, do that. So here in this case, prepaid insurance is going down by 200. So that is why it is credit. Insurance expense is going up. That's why it is a debit. Remember the rules of debit and credit. Any asset increase, any expense increase, or any drawings increase will be debited and decrease will be credited. At the same time, any increase in liability, increase in revenue, and increase in your liability capital, sorry, owner's capital would be credit, and decrease in the liability capital and the revenue would be debit. So you'll have to follow that rule in order to do the adjustments. Now, similarly, rent revenue earned during the year was 120. So that is why I'm uh, debiting the unearned rent because I'm taking out the earned part out of the unearned rent, and the rent revenue earned is 120. Next is fees accrued at the end of December but not recorded was 500. So since I have not received the money, accounts receivable is debit, fees earned is credit. And then wages accrued but not paid at the end of December total 250. So I'll have to debit to the wages expense, and then I'll be crediting to the wages payable account. Depreciation of office equipment is 50, so I'll debit depreciation expense and then credit the accumulated depreciation. So that's how I would do that. And then when we sum up these adjustments, we should get the same total so that we satisfy that we have done that correctly. And then add or subtract the adjustments. The next step is to add or subtract the adjustments to or from the amounts found on the unadjusted trial balance and enter the results in the adjusted trial balance column. Now I have given you a rule. What you have to do is, if you have started with a debit, like in this case we have started with a debit and no adjustment, so it's the adjusted trial balance would be the same. But account receivable is 2220 is the unadjusted, and I have done an adjustment debit. So this is a debit and a debit, so I need to add it up to calculate the new balance 2720. But in case of supplies, it's 2000 debit and a credit of 1240. So therefore this is a debit and a credit, so I need to subtract, take a difference between the two amounts and write in the column in which it has a greater value. So in this case 2000 is greater than 1240, therefore in the adjusted trial balance, I'll be calculating 760. Now I calculate the total and then see that they are same. They should be if we have done everything correctly. So as I said to you, preparing the worksheet as a spreadsheet will allow the computer to assist you in the process. Now what we do is, this is the spreadsheet using the spreadsheet Excel, and this is how it looks like in a spreadsheet column. Now what we do is we extend the amounts to the statement column. So once we have the adjusted trial balance, we can extend the columns to the income statement and the balance sheet columns. Although please remember, income statement and balance sheet are statements, they don't have a debit or a credit. But what we do is, for our simplification purposes, if you have an amount in the debit column in the adjusted trial balance, we'll be moving to the respective statements in the same column. So that is how we'll be doing. As you can see, this is the starting point of what we have essentially done is we have extended the worksheet. Actually, we don't need to write this account title all again. We have already written in the previous worksheet. We are just extending it. So how do you extend it? Since cash is a balance sheet item, we'll take it to the balance sheet column, and in the same column it appears here in the adjusted trial balance. It appears in the debit column, so that is why we'll be putting in the debit column, and the accounts receivable also is a debit amount, and we'll be writing in the debit column, and it goes to the balance sheet. Now till here, that is the capital and the drawings amount, everything goes to the balance sheet account, sorry, balance sheet. So that is why we are transferring all those, and the revenues and the expenses, they go to the income statement. So that's why we have transferred the revenues and expenses to the income statement column. Now the point here is the four columns. When you add up the income statement and the balance sheet, each of those sets of columns will have the same difference, like 16,960 and 9,855 and 33,545 and 26,440. Those two sets of columns in the balance sheet and two sets of columns in the income statement will have the same difference in amount, that is 7,105, and that is the net income. Now please understand, if the revenues are more, that's a net income. So that's why in the income statement we'll be writing in the debit column. But in the balance sheet, we'll be writing the same difference in the credit column because that net income belongs to the capital and capital is here in the balance sheet credit columns. That is why we are aligning that amount accordingly. Now, the difference between the income statement column total and the balance sheet column totals is the net income or the net loss for the period. That is how you will have to understand, and we write here as net income and write this in the respective worksheet. So that brings to an end to this presentation. Thank you very much for listening to it. I hope they were useful to you. Now, in the next presentation cycle of presentation, I will be doing a problem with you uh, to demonstrate how you actually do the complete accounting cycle.